Sunday, June 11th, 2017, Monaco 64, home of alternative economics and contrarian views. So I'd like to talk about the Federal Reserve and specifically the FOMC meeting coming up Tuesday and Wednesday this coming week. On Wednesday, June 14th, the Fed is expected to raise the Fed funds target from a range of 1% to 1.25%. Right now, it's on a range from 0.75% to 1%. And the first time they raised rates for almost 10 years was December 2015, when they raised the target from 0 to, the target was 0 to 1/4, and they raised it to 1/4 to 50 basis points. And that was the first time since June 2006. Then they raised it again on December 2016 to a target of 0.5 to 0.75. And lastly, March 15th this year, they raised it to a target of 0.75 to 1%. And now they're expected to raise it to a target of 1% to 1.25%. So that's the Fed funds target. And I want to also look at the price of gold and what it's done, in these last 2.5 years, when the Fed, did hike the Fed fund rates, and what it did prior to the rate hike, when it was basically priced into the market. I also want to go over some of the headlines I've been seeing, looking at Zero Hedge. Like right now, the latest headline is restaurant sales traffic tumble. And I quote, "The industry hasn't reported a positive month since February 2016. Another headline is that another Spanish bank, a small Spanish bank, or I think it's the 8th biggest or 7th biggest, Liber Bank, could also go under soon or be bailed in. The other headline that I saw that's quite interesting, it says on Zero Hedge, U.S. weeks away from recession according to latest loan data. And it says, while many conventional indicators of U.S. economic vibrancy and strength have lost their informational and predictive value over the past decade, GDP fluctuates erratically, especially in Q1. Employment is the lowest this century, yet real wage growth is non-existent. Inflation remains under the Fed's target, despite $4.5 trillion balance sheet and so on. It says one indicator has remained stubbornly fail-safe marker of economic contraction since 1960. Every time commercial and industrial loan balances have declined or simply stopped growing, whether due to tighter loan supply or declining demand, the recession was already either in progress or will start soon. So we've got all these anecdotal evidence that we are entering or very near a recession. And you might ask, and I've talked about this before, why is the Fed raising rates? They know what's going on. Why would you raise rates going into a recession? I personally think it's because then they can cut it again, because if we go into recession, they can't have rates near zero. It needs to be a little higher. So I've looked at the historical Fed funds rate going back to the 1950s, and I'll bring up a chart right now. As you can see here, since 1980, 1981, it's been on a downward trend. And, you can do technical analysis with everything, even the Fed funds rate. I know it's based on the Fed's decision, but if you look at it, since 1980, we're seeing, lower lows and lower highs in the Fed funds. And I drew a trend line here. It's not a perfect trend line, but it kind of tells us that we won't go much higher than 2% in the Fed funds. Or it could even, go up. Right now, we're going to be between 1 and 1.25. So maybe if they hike again this year, it's going to be between 1.25 and 1.5. So, and then they might stop, or they might do another one and get to that trend line. but it looks like, you know, they're very close to ending this rate hike cycle, and it's been a very anemic one, but it has been from zero. So yeah, I also want to talk about what gold has been doing, you know, since the Fed started hiking rates in December of 2015. So here's a chart of gold. You can see there that gold traded to a low of 1,045. That's a post 2011 low, you know, after the new all-time high around 1921. Yeah, on the same day or same week that the Fed hiked rates for the Fed funds rate for the first time since June 2006, gold bottomed there at 1,045, and then it traded up for the next 7 months or so, and then we had the second Fed rate hike. And just like in 2016, if you look at the chart, from February 2016, you know, gold started trading lower, you know, and traded low. And then, you know, when they hiked, it started going up. And the same kind of scenario here when the market was starting to discount that the Fed was going to hike in December 2016, you know, gold started turning down. And then it made a low in the same scenario, second rate hike since June 2016. In this, you know, I think it was December 15th. Gold traded to a low of 1122, and then it rallied to a high of around 1260, and then it started coming down a few weeks before the Fed hiked in March this year. And it bottomed at 1197, and then after the hike, gold traded up to around 1295 in the end of April or middle of April, and then it came down actually a little bit, and now it's been, you know, it's been going up since the beginning of May, and we've had, you know, this last week we made a new high. We failed to break that April 1295 high, and actually on the week gold was a little lower, but it looks like, you know, and I'm not saying this is going to happen. Yeah, things are never certain, but from what's happened in the last 3 rate hikes, you'd expect gold to bottom next week, specifically on Wednesday, June 14th, when Janet Yellen and her buddies at the FOMC are expected to raise the Fed funds rate. So this looks quite interesting, you know, and you can see that you know, the price of gold is actually acting quite well despite, you know, these rate hikes. You know, we haven't seen the big drops that we saw after we made you know, a top from the lows from that rate hike, like we saw, you know, from February 2015 to December 2015. There's a big drop. The same thing from, you know, July 2016 to December 2016. You know, we haven't really seen huge corrections from downward, you know, prior to the rate hikes now. And looking at this one here, it's almost insignificant on this weekly chart. So even though it was disappointing that gold didn't break through 1295 last week, I think gold looks quite strong despite you know, the fact that the Fed's going to hike rates next week. So, and the other thing I want to go through is in this video is that, you know, the last time the Fed hiked rates prior to the present cycle was in June 29th, 2016. And then they hiked, you know, they kept rates at 0 to a quarter from December 2008 to December 2015. For 7 years, basically rates were at 0. And, you know, and they've only raised rates, you know, by a measly, you know, 0.75% since then. So this, you know, in 2.5 years. So I think the Fed is still very accommodative, and it looks like the U.S. and the, you know, the global economy, you know, is going into a recession, and they won't be able to raise rates much further. They're probably going to have to start cutting maybe the beginning of next year, or even the end of this year. And that should continue to help gold, in my opinion. So yeah, that's what I wanted to talk about. It will be interesting to see if we see a bottom in gold from, you know, the top we saw last week at 12.95. Actually, it was 12.96. We broke the 12.95, but not enough to have a breakout. Yeah, it'll be interesting to see if we see a bottom, sorry, on Wednesday when the Fed hikes rates. We closed last week at 12.66. We could go down a bit further towards 12.50. We'll have to wait and see. I remember Richard Russell, who wrote the Dow Theory newsletter. He died, I think, a year or so ago, and he always said that the key level on his point and figure chart was for gold was 12.50, and that if we got back above that, that would mean that you know, the market was looking good. So I think 12.50 key level there, and we'll have to wait and see what happens. So if you enjoyed this video, give me a thumbs up, share it far and wide. If you like to receive updates, I make videos almost every day. Subscribe to my channel so you know when I make a new video. You can watch me also on steemit.com. If you like to donate as well to my channel, there's some links below in the description. I'll talk to you later. Bye.